And thanks to the Judo team and Hans and Greg's for giving up their time. This is invaluable at the moment for our broker network, given the state of play. And just hearing the updates, I mean, every day I'm getting phone calls from various brokers just wanting to know change of policy and procedures within the industry. And we were fortunate enough to be on the Judo Capital in those days, pilot program. So Judo is pretty close to the group's heart because of their support and their progress, and they're very active in the market. So I think it's timely, George and the team, for our team to understand what your appetite looks like in today's market and how they go about getting accredited and all those good things. So and it'll be good to hear from Hans from an economist point of view, and also Greg, who does a great job on the property market overview. So over to you, and on behalf of the YBR VOW network, thanks very much for putting it on.
Thanks for that, Mitch. Great intro. So welcome to the Judo Economics and Property update. You guys know myself and the team that's on the line. We've got in New South Wales, we've got Angelina and Ahilan. We've got Jim, Lee, Matt and Jono, as you can see, in Victoria, Bill in Queensland, and Latherson in broker support. That's the team and also they're supported also by, we've got 60 bankers up the East Coast, and we're in the throes of setting up in Perth as well at the moment. So I think it's about 25 bankers in Victoria, the same in Sydney, and about 10 to 15 in New South Wales as well. So the business is growing, and these type of sessions are really important to keep you guys abreast of what's going on. So this session is to provide you with that insight, specifically on the economic environment and how this COVID pandemic has had impact on us all. One thing I would like to reaffirm to you all on the line, which is now up to 32, is that Judo is absolutely open for business to support our brokers and their customers during these unprecedented times. Our lending book at the moment is at 1.5 billion, and term deposits since getting our banking license, to Mitch's point earlier, is also around 1.5, 1.6 billion as well. And you may have also seen the recent announcement by the government with their 500 mil investment in Judo as well. So we're well capitalised, and we definitely are open for business. So in terms of this session, it will be a Q&A session with our guest speakers, Hans Kuhnen and Greg Sugars. So please, I want this to be as interactive as possible. That's why we've made it a Q&A. Any questions you guys have, please use the chat box available, and we'll ask those questions, or we'll open it up if you want to ask the question yourself at the latter part of the session. So without further ado, I'll hand over to one of my colleagues, so Lee Tran, who will host the Q&A session with Hans.
Thank you, George and Mitch, for the introduction. So first and foremost, for those of you that have supported us over the past 2 years, our sincere thank you. So as George said, we've managed to build a lending book of over $1.5 billion. So without your support, it would not be possible for us to get there in such a short period of time. So that's an incredible result. And for those of you who we haven't had a chance to work with, welcome. And I'd like to take this opportunity to share with you a little bit about us. So Judo is a purpose-built, relationship-focused challenger bank specializing in the SME market. Our typical customers are small and medium businesses with lending requirements from $250,000 to about 15 million. We have built a team of very highly experienced bankers so that we can empower them to exercise good judgment, to make common sense lending decisions with speed to market. When we say common sense, what we mean is we don't have any rigid policy or parameters. We don't have a blanket view on any industries, but rather we assess each customer on their own merit based on the 4 C's principle. So being character, that's very important for us, capacity, capital, and collateral. That's enough from me for now. If you would like to talk to us more about how we can support your customer, please reach out to your local BDMs in the respective states. So now I'd like to introduce our first presenter for today's session, Hans Kuhnen. So Han was the chief economist at the State Bank of New South Wales in the early 1990s. And then he spent over a decade as chief economist at the Colonial First State Funds Management. Then in 2008, he decided to retire, but a few years later, he was invited by the St. George Banking Group to join them as chief economist for a one-year stint. He ended up staying there for 5 years. Then again in 2017, he decided again to retire. Now he writes and speaks on economics as principal and chief economist at Compass Economics. So without any further ado, I'd like to hand over to Hans now for him to share with us an update on the economy and what to consider post-COVID-19. Welcome, Hans.
Thanks, Lee, for that introduction. Welcome, guys. Look, as an economist, you've got to start off with humility in this environment. It is so strange and it's changing by the day. I know economics isn't everybody's bag, you know, we're boring, but the truth is we swim in the same pool. It's a pool of the economics, it's the environment we live in, so we may as well consider it and think about how on earth we get out of the mess that we find ourselves in. Sadly, not sadly, it's just not pure economics. There's health issues, of course, drive a lot of it, a lot of the decision making. This is my fourth recession. One thing you do learn is you get out the other side. There might be 10% unemployment and a lot of pain, but that means 90% of folk are still working and doing stuff. And it's getting that 10% back into the 90% is what it's all about, which is sort of focus of the recovery. I want to talk about three things very briefly: recovery from the recession, the fact of potential business failures beyond the recession, like into 2021, and then possibly the broader economic environment, you know, what on earth's going on in China and the United States. But the key is here, and the message has changed over the last 3 weeks. In terms of getting out of recovery, my concern was that they were going to pay for the debt that incurred because of the JobKeeper and JobSeeker with higher taxes, levies and stuff like that. They said, no, that's not the way out. Firstly, we're going to fill the pothole that's been created, i.e. the lack of business, the sudden suction of demand, and fill that with the JobSeeker and the JobKeeper and a whole range of other things for banks, for businesses, to support us all through this initial period. Yeah. We don't know how long it's going to take. I don't know how many of you saw Governor Philip Lowe. He's honestly expecting that we'll start seeing some sort of recovery after the June quarter. Now, that won't be full-blown recovery. It means they're taking the brakes off, which is a good thing. But we always recover from recessions. We just do, because once the thing that caused the recession starts to be resolved, the economy grows and absorbs the excess. But the fact is, if we've still got 10% unemployment going into 2021, that means demand is going to be constrained. There's just not going to be as much business out there, and businesses will fail. It's just going to happen. The weaker ones, the ones with the poorer balance sheets, the ones who've got the wrong product, the wrong approach to marketing or whatever, just aren't going to make it, simply because of the competition for the business that is there. You know, excessive costs, all those sorts of things. And then finally, it's all very well us talking about what we're doing here, JobKeeper, JobSeeker, a bit of money here, a bit of money there. But the truth is, there's only 25.5 million of us, and we do depend on the rest of the world. And if the US and China go into recession, this will be a longer period. So there's sorts of things that are concerning us. If you saw Dr. Lowe, he's expecting a 10% reduction in GDP has occurred. I don't know if you saw the job loss numbers. 720,000 people lost their jobs. That's stunning. That is off the charts. That is just off the charts. You see the loss of business from gyms, from restaurants, the accommodation sector. I mean, not every motel can take the Ruby Princess crowd and all the travellers. Everybody's being hit, and we now realise how interconnected our economy was. If we didn't before, sometimes you just take it for granted. But when one bit hurts, so does the rest. But I am confident that, yes, we will go to the other side. It still won't be pretty in 2021, but it'll be better than it is today. As for the United States, they're still finding their way. They're in a world of pain with the oil price. If they have recession, it just means global demand is weaker, and it just makes it harder for us. Not impossible, just harder. I'll stop there because I'm sure people want to ask questions, and that's what we're here for.
Thanks, Han. It was a very insightful update. So I'm just going to go back to you talk about the recovery, and Philip Lowe was talking about a recovery from the June quarter. So what will recovery look like in your opinion?
Well, it'll be phased. I mean, the government has promised us assistance for 6 months, which started March, so that's sort of September time. So there'll be that basic assistance there. The brakes will be let off as the health issue becomes less concerning. Now we're only seeing 1 and 2 new cases. We've got more testing kits. Soon this app will appear and you'll be able to see, okay, am I near a hotspot? Do I need to keep away from Woolies? Oh my gosh, Lee's got COVID-19. Do I keep away from it? All that sort of stuff. Those sorts of things, keeping that curve flat and improved testing will allow them to take off the brakes. We've seen it with elective surgery. The next phase will be say, okay, you can have a funeral with 20 people. You can go to church, but sit 1.5 metres apart. You can open your business, you can open your restaurant, but take out 50% of the seats or something. It'll be phased according to the health needs, just not a rush. The end game is finding a vaccine, but I think before then they will slowly release the things that have caused the loss of jobs, and we'll be able to go on a holiday, we'll be able to go to a restaurant, and that will just start the wheels turning again.
So you think that it's going to be more like a U shape or V shape sort of recovery? How long would it take before we get back to the pre-COVID-19 level?
Well, pre-COVID-19 will probably take the end of 2021, to be honest, because if we're going to have high unemployment now, it might gradually get better, i.e. below 10%, maybe below 8%, but that's still fairly weak. It's still a high level of unemployment. So it's not going to be normal next year. It's still going to be a struggle with modest demand, simply because, we've had an awful kick in the stomach and it hurts. So people will change their behaviour. They will save more. They will be more conservative. They'll think, oh, hang on, gee, maybe I do need to put a few more months worth of costs aside for another one of these. They suck. Who knows if we have a second wave and we have to go into lockdown again? I don't know the answers to that. I hope we don't, but people are going to be thinking about that is possible. So it really does depend on the health first, and then as the health issues improve, then we release and more people can get back to work. And you think maybe gyms will open and people will get down to the gym, release that pent-up energy. As I said, restaurants. I think professional services, they will start getting back to business again because social distancing is easier in an office environment. So, there's no magic bullets, but it's as we take the foot off the pedal, your business will improve because there's more people engaging in the economy.
You talked earlier about the 10% unemployment rate post, these contractions or COVID-19. So why are you confident that we won't experience the extent that, back in the Great Depression, for example, with mass business failures and unemployment reached 20%?
Look, unemployment rates got to 30%, and they would have done here if they hadn't introduced the JobKeeper. I think they introduced the job seeker thing first, and then somebody said, well, hang on. If nobody's doing anything, what are the people with business going to do? We're going to have a huge wave of unemployment. We'll introduce and spend 150 odd billion on the JobKeeper. And that sort of cuts the unemployment rate by half, from 20 down to 10. So it would have been, I think the whole policy response has been better. I mean, look at the interest rate structure. Immediately they cut interest rates. In the Great Depression, they did austerity programs. The government was trying to save money rather than pump it into the economy. So it's a different approach. The banks have reacted differently. Interest rates have reacted differently. Our currency is weaker, and the government has said, forget this surplus stuff. We really need to make the economy survive. If we can't get the economy to survive, what's the point? So they've pumped in $350 odd million of assistance. That's why. And I'm glad they did.
That's great. Thank you. So speaking on behalf of our brokers, because the audience are brokers. So with the, with COVID-19, what industry you think they should be looking out for, will have the best chance of surviving or thriving after this pandemic?
That is almost impossible to answer because we are so interconnected. When you look at the job losses in accommodation and food services, anything to do with people gathering and the supply of goods to them, the events industry, the accommodation industry, the restaurant industry, all of those will improve when the brakes come off. Manufacturing, there's a good thought. A lot of the problems that we've had, even with toilet paper, was simply not being able to get the supply. They couldn't get toilet paper because the wrapping came from China and the plastics. Now, if I was Coles or Woolies, I'd say, gee, I need an alternative strategy. I need to think about getting some of my supplies onshore. So if you look on the New South Wales government website, which I did, they're already saying, hey, we need manufacturers to produce more masks, more sanitizers, more shields, more respirators, all that sort of stuff. Now, that's just the health sector. Other sectors are going to be saying, hey, we might think about diversifying our supply chains, and that will bring business back to some of the manufacturers who are capable of doing it. But really, it's hand-holding for the ones that have been worst hit, gyms, travel, cafes, rideshare companies, petrol stations. I don't know exactly who your customers are.
Numbers on that, Hans, in terms of how hard they've been hit?
Oh, well, just in a week, accommodation and food services lost 25% of their staff. That was just in 1 week, and before that it was more. Gyms have lost 97% of their business.
Yeah, exactly.
Cafes are down by 42%. Service stations, petrol down 30%. Travel is down 84%. It's awful.
And some of the obvious winners.
Well, food delivery.
Yeah,
online gaming,
delivery.
alcohol
consumption. That's right. Tobacco sales.
Garden, home improvements. You guys are out there fixing your houses. You want to get back to work, don't you? Renovations, pharmacies. They've been the winners. Whether they remain the winners on the other side, I'm not so sure. There's only so much toilet paper you can buy. You can only feed your dog so much. So some of the crazy things will settle down, and some of the things.
I think I'll expand on that answer as well from our perspective, Hans. And I think for the brokers that are on the line, we talk about this a lot around understanding your own back book or your own clientele, and you can segment that based on those type of industries and start working through those and what type of support they need. No doubt you're getting inundated with calls from customers anyway, asking for those relief packages the banks are offering, but it's probably a good chance to segment your existing portfolio and then start working through that, and we'll be there to sort of support you with those that do require some support, and based on certain fundamentals and the credit assessment. Good question, Lee.
It is.
George,
your customers, your clients, get on the phone and see if how they're doing, whether they need hand-holding or a loan. Either way, you're their relationship manager. Relationships can be both good and bad, hard, difficult and easy. So, yeah, like George said, get on the line and show some love.
I'd just like to take this opportunity to reiterate again, if you have any questions, please feel free to use the chat box or take yourself off mute and ask the questions to Hans directly. But I have another question in relation, because you mentioned a few times about manufacturing in Australia. I think, if anything, this event has shown how important it is to have some local manufacturing capabilities in Australia, especially for essential products. Do you think that we will bring manufacturing back post this pandemic, and whether we can be effective, efficient, and competitive?
Look, we won't bring back the stuff that we lost. Holden, Ford, they're not coming back. We can't compete. We can't compete on mass tea towels and sheets and stuff like that. But for specialised stuff, look, if you were a business and you just seen your supply totally turned off, you would think, because of this and because it was imported, you'd think, yeah, maybe 15% of my manufacturing could go, my supply could come from somewhere else. But that's up to the manufacturing sector itself to contact these guys and say, hey, look, we may not be quite as cheap, but boy, you can rely on us. We're just down the road. We are flexible. Look, we may not be able to meet every demand for a Woolworths or a Qantas or any other big business's total demand, but we can fill the gaps when you have problems. So yes, there is. I wouldn't call it a whole scale return, but definitely the opportunities are there to fill a potential gap, because boards are going to be sitting, managers, owners of businesses are going to be thinking, we can't let this happen again because it nearly killed us. We really do need a plan B and C, and local manufacturing can do that. We've got the skill set, and I think part of the recovery will be actually a lot of money going into more training for apprenticeships and the sort of skills that these guys need.
Oh, so to expand on that too, Hans, sorry, Lee, I'm not sure if you're looking at the chat box, but to expand on that, we had a question there. Will this all result in a drop in overall price to manufacture in Australia?
If demand is low, take oil, for example. I mean, the part of the reason why the price of petrol and oil has gone down is because of a global slowdown. And the world is going to be a bit slower going forward. So yes, then again, a fair bit depends on the currency. But yes, if demand is weak and supply builds up again, that should reduce costs. That's just a demand and supply.
Yep. There's also a question there on your view on the cash rate over the next 2 to 3 years.
I doubt it'll go higher than 0.5. They've set the target at 0.25 for the 3-year bond yield. So they're sort of telling you that the 3 years at 0.25 is the most likely scenario. That's low. These rates are going to stay until we're well on the other side. The aim is to help the economy grow, and you don't do that by raising interest rates. Even at the long end of the curve, 10-year yields are below 1%. And if you've got weak inflation, which is the outlook for the next couple of years, the bond yields are not going to rise. So, yeah, a lower interest rate environment, particularly at the shorter end and even still at the longer end of the curve.
It seems like we have a lot of people interested in the topic. We have a few more questions here. One of them is, should the government take advantage of the current oil price to build up Australian reserve? Read somewhere that we only have about 18 days of supply.
Yeah, they're doing that, I believe. They're buying stuff or being paid to take stuff. Storage is the problem. It's a problem in America. They pump out more than they can consume. So they're actually paying people to take it and store it somewhere. This is the perfect time to be rebuilding our strategic reserve. It'd be good if we could store it in Australia. Apparently they're storing it in America, which is a bit odd, but that's the way it goes, because we don't have the capacity, apparently, to store it either. But at the same time, with interest rates this low, the government could borrow at 0.25 for 10 years. I mean, think of what you could do with that money if you were the government. Surely you can put it to productive use. So borrow and build is a phrase that I like to use.
There was a question about wages. So what will be the impact on wages, such as salespeople in banking post-COVID? Do you think will they hold a drop or increase?
With demand weak and a large amount of unemployed people, it's difficult to see wages rising. And in brackets, I do hope that wages of nurses go up, because I just can't understand why people who save lives get more than some people who... Anyway, that's another point. But no, the wage pressure will not be large. The government, which often sets the pace, is constrained, so it can't be paying public servants too much, and that will feed through. But with unemployment rates higher than what they are today, trying to get a wage rise will be difficult. It's survival. You're lucky you got a job, and I think people will accept that for a year or two, or at least a year. Here's hoping.
Thank you, Hans. Yeah, well, thank you. Well, in the interest of time, we'll probably park it there, but please do continue to send in your questions, and we'll circle back at the end if we have more time to go through more discussions. Thank you. Now our next presenter I'd like to introduce to you is Greg Sugars. So Greg is the CEO of Preston Road Patterson Australasia, one of Australia's and New Zealand's most experienced and well-regarded property services companies with expertise across a full spectrum of property classes. So Greg has been involved in the valuation industry for over 30 years. He has been the forefront of the valuation industry aggregation and technological advances. So firstly, as the founding CEO of Optian, and since 2011 with Preston Road Patterson. So he's a fellow of the Australian Property Institute and the Royal Institution of Chartered Surveyors. Greg is involved extensively with property industry groups, and most recently was part of the API's working party on alternate inspection methodologies during a declared state of emergency. He's a proficient public speaker and has given many talks on the property sector around Australia. And in 2015, he was awarded a Medal of the Order of Australia for his services to the community. So welcome, Greg, and now I'll pass on over to Greg for him to give us an update on the property market and the impact of COVID-19.
Thanks, Lee. Thanks, George and Mitch, for having me on today. Look, the property markets, it's a bit like how big's the crystal ball that we can look into the future. But some of the things that I probably want to get across today is that all different parts of the market will perform differently. There's not going to be a uniform effect on the market for what's going through this COVID-19 period. We've seen some sectors of the market, which I'll get into a bit later, affected more than others, and some will take longer to recover than others. Probably some of the things that have been brought on by the COVID-19 may have sped up some of the trends that we were already beginning to see, and in that instance I refer to retail, the decline of retail property sector, and we'll probably get the chance today to cover off on what's a bit different this time compared to the GFC and back in the early 90s when I first started in the business, when we had the recession we had to have.
Great, thank you, Greg. So it's a nice segue to my first question. Is you talk about the different impact on different part of the market. Can you please elaborate on that and talk about which part of the market that is more affected than others, both commercial and residential?
Yeah, so I think probably the first most important thing to think about is that 70% of all the world's wealth is held in property and infrastructure. So it's it's a pretty important sector, and as I said, all different classes of assets will perform differently in any cycle. So I might just go through a few different sectors and then talk about some of the interventions that have happened to date and how they'll affect those cycles. So I'll start off by saying, something like the agricultural sector at the moment, property in the ag sector, is travelling really well because food security has all of a sudden become a really important issue. So we've seen a number of very key agricultural assets trade in the last month at better than expected prices as people are trying to shore up food security. If I talk about commercial, property or non-residential property. I talk about commercial property as in our office buildings that we all work in normally and we're enjoying not commuting to every day. I know, well, certainly I'm enjoying not having to spend 3 hours a day in the car. Talk about the retail sector, and then I'll talk about the industrial sector, and they're all performing very differently at the moment. And then I think if we look at moving forward, again, are we all going to want to go back and work in our office, or are we all happy to sit at home with the dog barking at us and we're doing video conferencing? Oh, I'm pretty sure I'm going to want to go back to the office. But look, if I look back what was happening over the last 12 months, for the first time, or say 18 months, for the first time ever, since I've been in this industry, we always used to class commercial office property as sort of the A grade. This is the pinnacle of what we want to invest in. And then we had the retail sector, and then the poor third cousin was industrial. Well, in the last 18 months, industrial has started to move ahead of retail, as we've seen the decline of retail strips, mainly due to the change of the way we go about things with internet shopping and things like that. So, you know, I think the latest figures show that about 12% of all goods purchased in Australia are bought online now. So retail was already facing some challenges, and you only have to go and look at you know, some of the big shopping centres like Chadstone and Chatswood and places like that, and you notice that they're actually not shopping centres anymore, they're entertainment destinations. So they are beginning to change what's happening there anyway. So you've got restaurants, you've got Legoland in the middle of a shopping centre, you've got theatres, you've got all sorts of picture theatres, you've got all sorts of things, bowling alleys, you've got all sorts of other alternative things happening. So the retail market was changing anyway, and now you just have to go down one of the main high streets or main streets of any town and just look at the police boards going up, and that will be exacerbated. So when we talk about what's happened with the Commonwealth Code of Conduct for commercial leasing, so we've got rents beginning to be you know, rent relief being given for businesses that have had their turnovers taken reduced. We've also got the amortisation over those waivers over the extension of a period. So the way we value commercial property is going to change, because we're now going to be looking at, you know, what the face rent is. So is it, you know, $100 a square metre, but that actually in reality is $30 a square metre because the business is reduced in turnover. And so what does the cash flow for that look like? So for those sort of commercial properties, we're going to see some changes, and it depends what sector. We always used to say the best tenant was an ASX listed company. But hey, if your ASX listed company was Virgin or Flight Centre, maybe that's not such a good thing anymore. And maybe landlords will be starting to look at and say, okay, what is the business that gets operated by my proposed tenant? And is it one of these bulletproof businesses like food, like as in supermarkets and things like that, as opposed to what we traditionally thought, you know. If you look at Solomon Lew came out yesterday and said, I will not be paying rent on any retail property that I lease in Australia for the whole period of this lockdown. Don't worry about reducing the rent by his turnover. I just won't be doing it. You know, well, you know, Country Road, Peter Alexander, all those brands that you thought would be great tenants in your shops, maybe not so more anymore. So retail's been really affected. That's a really long answer to get to that. Industrial, we've got more logistics happening. Whilst we're going through this, we've got more deliveries happening. So the industrial sector probably hasn't been affected so badly. And again, that really points to what we were already seeing in the trends beginning. Tourism. And then when I talk about property, I talk about not only is it the classes of property, but it's the geography of where they're located. So Cairns and the Sunshine Coast and the Gold Coast, those are areas that are just going to take forever to recover after this, because they are so dependent on that tourism dollar, accommodation, restaurants, cafes, all those things where there's been no activity whatsoever. One of my favourite things when I talk up on the Gold Coast is I always count the lights on in the apartment buildings at night. And for the last 2 or 3 years, they've been about 25% occupied. And I think, you know, we're going to see that a long stretch. So on the other side of this, I think if you want to buy a holiday apartment on the Gold Coast, it might become a bit cheaper. In the residential sector, we've seen things like the trophy properties, the high end, still trading really well. people with money at that end have cash. They don't really, they'll still buy the properties that they want to buy. At the moment, at the bottom end of the residential market, we've still had a lot of pent-up demand. So it's okay. But as people start to lose their jobs, based on history, we'll see that begin to change a little bit. And I think probably the band that we'll see the most changes is that $1 million to $4 million on the East Coast, where these are people who have small businesses, the people that probably are looking at injecting capital back into their businesses to keep them going during times like this. So we might see some property movement in markets there, and we've probably already seen that come off 5%. On the East Coast, Sydney and Melbourne, and we're probably predicting that'll come back at least 10% in that.
Thank you, Greg. Just going to that question. So, with this current pandemic, do you see any similarities, or can you draw any conclusion to this time compared to the previous events, such as the GFC?
Yeah, absolutely. So, unlike Hans, I've only been around for 3 of the the downturns. But if I think back when I was first a valuer in the early 90s, when we had the recession we had to have, interest rates were 18%. So if somebody got behind, their arrears was accumulating really, really fast. And back in those days, my job as a valuer, I spent every weekend going and holding a bank manager's hand while he actually went to a mortgagee auction, and he was setting the reserve, and the reserve was going down week by week. And the banks were beginning to flood the market with repossessed properties, and they were creating their own market, and it was going down. So 2 things have happened, obviously, since then. We've had a Royal Commission where nobody is selling up anybody, and most things that go into arrears are probably sitting in the bank's arrears department for a couple of years. But 2, interest rates are so low that, they can afford not to have to flood the market with these properties. They can hang on to them, because really, if people have got some equity in them, even if they can't pay them back, before the bank gets backwards on it, it's not really going to be an issue for a period of time. So we'll probably see that'll be a huge difference to that. In the GFC, obviously, the biggest issue was that the actual confidence in the banking sector itself. So the banks weren't lending at all. This time around, we've got the Commonwealth government has actually given money to organisations like Judo Bank to, help people through the situation. That money just wasn't around in 2007 and 8. So again, we'll probably that's going to be a very different factor this time around in the property market.
Right. Thank you. With the social distancing as well, we see more and more delay issues with when it comes to evaluation. Is there a way to speed things up so that we can get deals through the pipeline?
Yeah, absolutely. So what's happened there is we're probably seeing about 4 or 5 weeks ago, about 20% of our inspections we just couldn't get in because people had either returned from travel and were in isolation. People were scared about what was happening, so they just didn't want a stranger coming to their property, and that's commercial and residential. The Australian Property Institute on the 30th of March declared what they call a state of emergency and changed the requirements for valuers that we didn't have to do an internal inspection of a commercial or a residential property. So that was a huge thing because, as long as the sun's been in the sky, that's what valuers have had to do. But the second thing was the banking industry as a whole got together and said the whole pipeline's going to stop if we can't get people moving through properties. And we as credit providers have to accept the inherent risk that, this property hasn't been inspected top to bottom. So, and I'll give kudos right now to Judo Bank. They were one of the first banks to sign up for this, in that they said, okay, we're prepared to accept this. And what they said is that the valuers could do an external inspection. We can go and measure up the outside of the property, but if we couldn't get into it and no one wanted us in, they'd accept what we call a owner-assisted inspection. And we use technology. So we developed an app where they take photographs for them. We direct them through what we want them to look and see, and they fill out a questionnaire for us. And Judo certainly accepted that as a way to speed things up, which should be great comfort to the brokers. And it's sort of hierarchical. Our first port of call is obviously want to do a full inspection. If we can't do that, we go to the outside, we measure it up, we get the owner to assist us or the occupant. The third is, okay, we might be, and like we were in New Zealand, we're in stage 4 lockdown, so we can't even drive out there. We're not allowed out of our homes. So it's all done by the occupant. And the final one in the hierarchy is we use what we call a virtual inspection, is that we just use all the material that we've got through blockchain, through all these other things, and build a story about the property from what we know, past pictures on the internet, council records, all sorts of things. But we probably haven't had to go to that extent yet. But it's moving again. So at the moment in, say, the northwest part of Tasmania, we've got half the people in Burnie, for example, are in lockdown. We can't inspect hardly anything up there. So we're using this methodology every day, and it's working really, really well.
Oh, that's great. I noticed that in recent valuation report, the terminology material market uncertainty is started to appear more and more frequent.
Yeah.
Can you talk to us about the concept of that? What does it mean?
Yeah. So material market uncertainty happens in a marketplace, and we had it in the GFC as well, where if the market stops trading, obviously valuers use evidence that's available in the marketplace to assess what's happening. And if transactions slow down, so certain classes of property will slow down and we'll stop getting evidence that we can base our figures on. It's a warning, I suppose, to the bank that we don't have sales within a certain time period or in exactly the same circumstances. So if we go back to what valuations is all based on, a simple definition, market value is a willing buyer and a willing seller, neither of the parties knowing anything more about the property than anyone else, and it's the price they'll exchange it at. Sounds pretty simple, but always someone knows more about it. So if we look at, say, development sites at the moment, while we're in this situation, we probably won't see many development sites changing place, and we're already seeing that market thin out a little bit. It'll stop. So market uncertainties, we'll have to say to the lenders, if we're doing a development site at the moment, there's not enough evidence in the marketplace, and it's just simply a warning to say this is where it's at. It's an international definition, so that definition has been released around the world for the accounting, valuation and banking sector. So everyone in the world's working for once on the same definition. And if you go to our webpage, you can download a copy if you want.
That's good. Because I started thinking, oh, it didn't really happen in the past, but now I'm seeing more and more of that. Yes, people on the line, please feel free to send through the questions if you have any for both Hans and Greg. We have a question here for Hans. Do you have a view on money markets such as securitization over the short term?
The honest answer is no. I just don't know of any companies that are or institutions that are looking into it. It's not really my area of speciality. That's sort of a more funding side. So I'll admit my inability to answer the question. That's just.
So I've got a question here for Greg, and we'll come back to, we'll circle back and answer to that question too, Michael. But one for you, Greg. So are we going to see a landlord shift their expectations on their more so long term, or do you see a short term impact to rentals?
Yeah, look, so
is this going to be a societal change which is going to shift the expectations of rentals?
Yeah, absolutely. So one of the things we'll see is and it'll happen definitely because of just the circumstance. So for retail property is a really good example, is we've had a lot of landlords traditionally hold on to a vacant shop for a long period of time and not even try to relet it because they've had a tenant who's still on the hook for the rent, even if they've moved out. Obviously now we'll probably see, as Hans said, more businesses go to the wall, insolvencies and things like that. So that money won't be coming through. The reason the landlords would do that is that would have been based on a market rent, which the bank was happy with when they lent them the money. Their LVR would have been beautifully in line. But as rents start dropping, then obviously their LVRs will change as well. So they would always just counting on that face rent, even if some of them were, a lot of landlords were doing other deals, they will give you a rebate, in behind the scenes, to just try and keep that face rent up. But I think what we will see moving forward is that that the market will start to change its behaviour. And again, I think, as I said before, one of the things is that a landlord will be looking at is the business of the tenant will be so much more important than what it's ever been before. Yeah. When we talk about industrial property, if one of the things that the government in history has done is to try and stimulate a sector like manufacturing, they've increased tax depreciation on buildings in the industrial sector. So when they were trying to stimulate in the 80s, say 87, the manufacturing industry, they said, okay, you got two warehouses next to each other. One's for storage and one's for widget making. The one for widget making, you could depreciate your building over 25 years, but if it was a warehouse, it's over 40 years. So they might bring some intervention in to stimulate certain parts of the market. So therefore, a landlord will be looking and say, great, if I've got someone who's in manufacturing, that's a far better tenant than someone who's just using it for storage, for example.
Yeah. Really.
I have another question. Sorry, I have another question for Greg. You talk about before the office building and people probably, after the lockdown, keen to get back to the office and work in the office environment. But as a business owner, they probably have invested quite heavily into technology to allow their people the capability to work remotely. So post the lockdown, post COVID-19, they have to try to save money somewhere. Do you see the possibility of business owner try to reduce the footprint, having a smaller office space and encourage more remote working for their staff?
We've already seen over the last sort of 3 or 4 years in the commercial office sector, businesses like WeWork and things like that really become popular because people were looking and saying, okay, if I have to expand my workforce in a fast way, how do I get extra space? And we used to always say it would be great to have a 5 by 5 by 5 year lease for a commercial property manager. But more and more businesses have been trying to become a little bit more flexible on that and say, actually, we can only plan 2 or 3 years out. So landlords hate that because they want certainty and surety. But tenants are the other way around. I think we will see a little bit of a change. I think the social thing of people working, if I take my business, for example, we've tried the whole remote working thing for a long time. And what we found is the mental health of our team, people who want to learn and get mentored, it doesn't really work when you're working remotely. So people have to come into an office environment, into a group environment. But we've done a mixture. So we've probably got less office space than we've had in the past. And I think more and more businesses will probably head down that pathway. I mean, we're quite lucky is that most of our guys are out on the road, for 70% of the day inspecting property. So they're not using the office space. But, and hopefully in the banking industry, for example, you're out seeing clients a fair bit of the day. But, people, again, open space, there's been a lot of studies in the last open plan office in the last 18 months. I think Harvard did a study on whether open plan offices were working, and they came to the conclusion people hate them and it wasn't working as well as they thought it was going to work. And everyone needs their own private space. So, it will change.
Great. Thank you, Greg. We have a new questions for Hans, but please feel free to add your views to Greg. So Hans, with 130 billion coming into the market, government stimulus in 6 months, plus the current economic activity, do you think there will be a boom in equity and property markets rather than a doom scenario?
Good question.
You've also got to keep in mind that tens of thousands of people have just been allowed to take money out of their super. And you're already seeing that in the property market where industry funds that are illiquid having to sell assets. The equity market present is so volatile. Excuse me, I've got to turn this stupid phone off. The basis of the equity market is earnings, and if the economy is going to be flat, so should the share prices. There's the degree to which they were overpriced before this, with the market, the All Ords at 7,300 and so on. It's come back down probably more than it needs to. So yeah, so there can be a bounce, but I take the fundamentals. If we're having a slow period of demand, earnings is going to be very difficult to justify. And I guess it's the same in property. If the demand's not there, where's your yield going to come from? Where's your valuation? So I don't see our market. I'm pretty sure that's the question. I don't think our market, equity market, is going to particularly take off, because it was a tad overvalued. It's now come back too far. Yes, it could go up towards the 6,000s, but that's that'll take time. That'll be next year, I think, not this. Was that the question, Lee? I got confused.
It was the first part. I think the second part was the property market as well, which I think you touched on somewhat.
Yeah. Oh, well, look, people used to run to property because they hated shares and volatility. Well, guess what? Property has similar problems from time to time too.
Do you see the same thing happening, Greg, in terms of
I think
shifting from the equity market to the property market because of the stability?
We've seen that over the last couple of years, definitely. And if you just look at the investment in the property market by super funds, has been huge. What we've seen over the last month is a number of the listed and unlisted property trusts all of a sudden realise that they've got some issues with investors who are trying to pull funds out and to try and get liquid again. And they're going to start letting go some of those big assets, those big office buildings and hotel complexes and things like that. So that part of the market will change. Where we've seen commercial property, the yields, people have been chasing yields in property just like they do in the share market, but we've seen some amazing transactions, people buying property on 3% yields and 4% yields because that looks like a really attractive return, and they're just counting on the capital growth. So that's what's been driving the market. So we've had a lot of super funds in, but they're competing with the institutional investors as well, institutional property trusts and things like that. So I think we'll see some of that competition go out of the market. So I don't think it will be a boom, if they answer the question.
Yeah. If I just might get back to it, the stimulus is to fill the hole, the pothole, to try and keep the economy going. It's yes, it's a stimulus, but it's more like an adrenaline shot to the body to keep it alive, rather than to get it doing a marathon. It's gap filler, not construction. So property and equities, no great reason for boom other than just the change in sentiment. Hey, we're getting out of this, but at the end of the day, we've got to see the earnings. Banks' dividends are going to fall. Do you want to pay what you used to pay for a bank if it's going to cut its dividend in half? No is the answer.
So there's no chance of us trying to make a quick buck then for the next 12 to 18 months. Well, thank you both so much for your time and for sharing your views and provide us with the insights into the economy and the property market. It's been very helpful for myself personally. I'm sure for the audience as well. So thank you so much, and I'll probably throw it back to Mitch now for any closing remarks.
Yeah, thanks very much.
Mitch.
Thanks very much, Lee and George. Certainly a session of relevance, and it was great to have someone of the calibre of both Hans and Greg with their areas of expertise and relevance today. I think that's the most important thing, is the communication. Thanks for the sales team and the YBR brokers. Anyone that's dialed in later, this has been recorded and will be available, I understand, George. I think speaking yesterday, Angelina. So thanks very much. Send any other questions through and I'm happy to field those across. Thanks to Judo Bank, and we look forward to dealing with you from a number of fronts over the next 12 months. Thank you.
Fantastic. Thanks, Mitch.
Thanks, guys.
Thanks, guys. Thanks very much.
Thanks, guys.